I think the sound is on. I'm not sure if everybody can hear. We're aiming to start as close to 1 o'clock as possible. So we'll just hold on a few minutes and then we'll see how many people have joined, because they are joining, but it may take time. So bear with us. Thank you.
Hi and welcome everyone. We're just going to wait just a couple of minutes just for everyone to log in. The numbers are slowly filling up. We're about 80% there, and I'll let you know soon. I think we should start. We'll just do the introduction. First of all, welcome to the first session of 2022. Today, I see that winter's beginning to show its face. Today is probably a good day to get into bed with a good book or with somebody who's read one. So hopefully Prof. Jackie will warm us up a little bit. And as usual, Jackie Arendse needs no introduction, and I'm going to hand over straight away
Your certificates and everything will be on its way after the session in the next couple of days. It shouldn't take too long. And thank you for attending. And Jackie, the floor is yours.
Thanks very much. Thank you, Stan, and good afternoon, everybody. It is wonderful to have you all logged in today. And yeah, hopefully we are in for an interesting discussion. I think you've probably all seen the highlights of the budget speech, so I'm sure I'm just telling you stuff that you know already, but hopefully there will be a few extra little snippets of information as we go along, or perhaps a little bit more understanding of how some of these things are going to impact on you. Okay, so just a bit of housekeeping. We'll start now, obviously, and then we'll run through until, we'll go for about 1.5 hours. So we'll just go until just after 2:30. Then we can take a 20-minute break. I'm sure you'll all need some refreshment at that stage. And then we'll carry on from sort of 10 to 3. I'll give you the exact time when we take our break, and then run through for another hour or so, and then finish just before 4 o'clock. Okay, great. So let's go straight into it. We're going to be talking about the tax highlights of the 2022 budget speech, and just looking at the main tax proposals. And I'll be running through all of these in a lot more detail, but just giving you the sort of high level at this stage, looking at the company tax rate coming down, but just important to note that that is being offset with tax-based broadening measures. Looking at the increase in the employment tax incentive, there's also another sort of, can I say, a downside, or a sort of a reality check on that one, is that they're also going to be introducing the understatement penalty for overclaiming ETI, and then some sort of inflationary adjustments to the personal tax threshold and rebates. That stays unchanged. I think, I don't know how many people seriously thought that VAT might increase, but it was something that was being bandied about in light of the expectation that government would need a lot of additional tax revenue. And then we see fuel taxes unchanged. Some commentators are saying that government missed their opportunity there, but nonetheless, we're not going to get into the detail now. I'm just doing this high-level overview at this point. What we do see coming through are increases in the environmental taxes, which are I often call them our stealth taxes, the taxes we don't really notice, but they factor in through the price of goods. And so we're seeing quite a few increases coming through there, and more than just inflationary increases in many cases. Sin tax is also increasing, and sometimes by more than inflation. But on the other hand, when we look at wealthy individuals, wealth taxes, etc., we don't see any changes coming through there. So estate duty donations tax staying the same, even the transfer duty rates staying unchanged, and the tax rate on trusts remaining at 45%. But what we are seeing is this announcement around wealthy individuals, and it's really just maintaining this ongoing focus on wealthy individuals, and with the announcement in this year's budget speech sort of looking at getting more information from wealthy individuals. And then towards the end of the presentation, I'll talk about the Annexure C amendments, which are fairly brief at this stage. Whether that's going to expand as time goes on remains to be seen. Okay, well, let's go straight into it. I should also just mention that if you do have any questions as I'm going along, you're welcome to pop those into the chat box. That's probably the best. I guess you could raise your hand, but I'm not 100% sure I will see your raised hand. So I think the best is if you just put your question into the chat box. If you do want to verbalize your question, you can raise your hand, and I'll have a look at when we take a break, and to see if there are any raised hands, and then I can take your question at that stage. Okay, so let's go on then into the detail. But before we get to the tax proposals, I do just want to talk a little bit about the revenue trends. I think, it's quite interesting when we look at the revenue trends over the last few years. And what I'm showing here in the budget column is what was originally budgeted for, because what often happens is that these numbers kind of get changed along the way. And we sort of lose track of what was originally budgeted. And I'm always interested in what was originally budgeted, and then have a look and see what the outcome was. And we know that all the way through to 2021, because that ties up with the SARS statistics that were released a couple of months ago. And then, of course, we have a revised budget for 2022. Now, what is interesting is, of course, if we look back over the last number of years, we saw that in 2018, this runs according to the government year end, so it'll be March 2018, a slight overrun, budget exceeding, well, the outcome exceeding what was originally budgeted. But thereafter, it seemed to just be a sort of an increasingly steep downhill slide in terms of the shortfall. So 10 billion shortfall in 2019, 58 billion shortfall in 2020, 160 billion shortfall in 2021. This was in spite of there being a little bit of a windfall last year. Some of you might remember in last year's budget speech, we also supposedly had a bit of a windfall to assist us, but nonetheless, we still ended up with our revenue collections falling almost 160 billion rand short of what was originally budgeted. Then it's interesting that the budget going through to this year, so up to the end of March 2022, so this would have been set back a year ago, we see that revenue was actually projected to be lower than what they were looking at, what they had budgeted for last year. And of course, then we came in with this huge overrun in terms of actual. Well, it's not actual just yet, but it is the expectation based on what has been reported thus far. And looking at the mining companies with December year ends and so on, and looking at this massive now overrun. What they talk about is 182 billion rand windfall. If we compare it to the original number, it's actually closer to 197 billion. Sorry, my slides are jumping around here a little bit. And I'll explain that windfall in a bit more detail on the next slide. But before I get there, let's just complete this table. And we'll see that when we look forward to next year's revenue going through to March 2023, we in fact see quite a healthy number there again. So we see 1.588 trillion compared to 1.352 trillion, and that's quite a substantial increase. So when I look at that number, it tells me that although the big question is whether this windfall, this commodities boom that has driven the windfall, will be sustained, it seems that National Treasury is projecting that it will be, based on their higher level of revenue for next year. Well, of course, I mean, that all remains to be seen as to whether they actually hit this target or not. But it just seems quite a strange trend in numbers there when you look at it, and then looking forward at what is projected for next year. When we look at this windfall, so where does this windfall come from, this 182 billion rand windfall? So this is, as I say, it's a revised 2022 outcome compared to what was budgeted in 2021, but for 2022, right? So this is what was budgeted last year, and this is what the revised projection is. And if we look at personal income tax, we see even there's a significant positive deviation, so an overrun. We're collecting more than what we originally anticipated, to the tune of around 38 billion rand. Now, of course, most of the deviation does come from corporate income tax. We see there 105 billion, but it's interesting to see that even on the personal income tax side, there's about a 38 billion rand overrun. And of course, we could say, well, how does that work out? And I think there's a couple of things here. The one, drawing from an interview with the Commissioner, Edward Kieswetter, a couple of days ago, where he was making the point that the windfall is not entirely due to the commodities boom, that there is some credit that should be given to SARS for their collection efforts. And I think this is probably what you're seeing coming through here with this 38 billion. Some of that is because of SARS increased collection efforts. Maybe also the cynical amongst us might say the delayed refunds, who knows? But then I think what is also a factor that's coming through here must be that government wages ended up being higher than what was originally budgeted for. And sorry, excuse me a sec, got some interruption here. Some people have children at home. I've got dogs and they were interrupting me, sorry. Okay, so what I was saying here is that with government wages being higher than budgeted, it's quite possible that some of this deviation is coming through the additional taxes that flow from those higher government wages, right? Because a large portion of the employees' tax that we collect is coming through the government payroll. All right, so that deviation, yeah, is quite an interesting one. The corporate tax deviation, we have been told largely is due to the commodities boom, and whether that will be sustained, we don't know. And that also comes through to the dividends tax overrun of about 6 billion rand. Of course, this will be looking at dividends tax actually collected up until the end of March this year. We also see that VAT is more than budgeted, which is quite an interesting trend there as well. I can only surmise that the budget here was somewhat conservative, and that as a result, with economic performance and so on being a bit better than what they thought this time last year, it's produced more VAT. And then we see specific excise duties coming in again higher than budget, which is really interesting because this time last year, we saw that specific excise duties was way short of what they had originally budgeted for as a result of the COVID restrictions that had kicked in during the course of 2020. Of course, we didn't see that same degree of restriction coming through on the liquor and tobacco industry in the latter half of 2021 going through to March 2022. And so we see here again, probably a conservative budget and then coming out somewhat higher than that. And I think we could say the same for the fuel levy. So it's just interesting to see, this won't exactly add up to 182 billion, but it gives you the bulk of where that 182 billion supposedly windfall comes from. And so, yes, largely as a result of the commodities boom, which has driven higher profits in the mining companies. And then, of course, the big question is, to what extent will that be sustained? Well, of course, things have changed quite substantially since the budget speech was presented barely a week ago, because in the meantime, we've had all the developments with Russia invading Ukraine. And of course, it remains to be seen what impact that is going to have on economies all around the world, and specifically in terms of South Africa, what impact will that have on our economy? I'm sure there must have been some degree of those risks factored into the budget, because of course, this is not something that suddenly was sprung on us overnight. It has been looming. So they must have factored those risks in to some extent, but certainly nothing like what we are seeing now with the actual invasion going on. Okay, anyway, I'm not here to be an economic predictor. I just want to show you these trends in revenue collections, because obviously this is a reflection, it's an outcome of what has come through the tax legislation. And I think what is also interesting is that we look at the revenue composition in South Africa. This is the bottom line over here, is the South African revenue composition. And I've put this in here, comparing this to the rest of Africa, Latin America, and the OECD. Now, the OECD, of course, is our major industrialized countries. There are sort of 36 countries in the OECD. We are not a member of the OECD, so we are not featured in these numbers over here. But when we look at these major industrialized countries and where they get their tax revenue from, it's a reasonably fair three-way split between personal taxes, social security taxes, and this over here would be VAT. Now, social security taxes, of course, one could say is really added on to personal taxes, because it's really paid by individuals towards the national, sort of nationalized pension fund, if you want to put it that way. So yes, it does mean that there's quite a large collection coming from individuals. But what is interesting, of course, is that the social security is earmarked, and that's only used for that purpose. It's not a tax that goes into the general government coffers. If we look at VAT, it only contributes, say, 20%, whereas we're a little bit higher than that at 22%. And company tax only contributes 10% of their total tax collections, whereas ours contributes 15%. That's also a reflection, of course, of our higher company tax rate, our company tax rate having been 28%. And we know that that has been quite significantly higher than the OECD average, which was sitting a couple of years ago. This is based on 2019, 2020 statistics. At that stage, the average company tax rate for the OECD was only around about 20%. It's now around about 22, 23%, because these company tax rates have been kicking up a little bit following the economic challenges of the COVID pandemic. Okay, so just an interesting trend that we see there. Also interesting that we see property taxes featuring much more solidly than what we see in South Africa. And then your sort of general consumption taxes. With us, that would be our fuel taxes and all that sort of thing, our environmental taxes, fuel taxes, and so on, comes into that band over there. But what is also interesting is when we compare South Africa to the rest of Africa, very different. I mean, we kind of replicate OECD a little bit more than the extent to which we fit into the rest of Africa, because the rest of Africa focuses very heavily on indirect taxes. And you see that coming through with the VAT or whatever equivalent tax they have, and then these other consumption taxes. So that together makes up more than half of their total tax collections, whereas with us, it comes to sort of 40%. So quite substantially a much greater reliance on indirect taxes, slightly more reliance on company tax, and then very much less reliance on personal taxes. So the reason why it's interesting to look at this is because it does give us an indication of, you know, what our tax pattern will look like in the future, because it's not really going to deviate significantly from this. This is really our tax policy in a nutshell. Is this one little bar over here in terms of where we get our taxes from. And so going forward, yes, we might have slightly less reliance on personal tax if we manage to get more from corporate tax, but that of course really remains to be seen, although National Treasury's projections tend to indicate that this might go up to sort of 16%, that might come down to 37%, and VAT will stay more or less the same. But it's always going to be, well, certainly in our current fiscal policy, it's always going to be kind of within these kind of parameters. All right, so we're still going to have this ongoing focus on personal taxes and to a lesser extent corporate tax, and yeah, a little bit more than corporate tax, but less than personal, focusing on VAT. And of course, let's not forget the green bar, which is your other consumption taxes, mainly in the form of our fuel taxes and our specific excise duties. Now, the question that's come through is, what about the SARS penalties? Now, that's an interesting one, you see, because the penalties don't get separately reported over here. So we don't really have specific information on those penalties. What we do see is a little bit of information on the interest that is collected on outstanding taxes. And what I have seen from the SARS statistics is that you know, corporate tax, there's sort of, if you take it as a percentage of the tax collections, there's more interest paid by corporates than by individuals, which tells me that individuals are perhaps a little bit more compliant than corporates, who knows, or they're more up to date with their tax payments. So, but it still doesn't tell us a lot. We know there's about R1 billion interest from individuals, there's about 2.5 billion from companies. But as far as penalties are concerned, short answer is we don't specifically have that information. Okay, but I think it sends, you know, it's just an interesting picture, and for us to bear in mind when we think about our taxes going forward. And that's also why there's always big concern around our personal tax rates when we see that government is indicating that they want to increase tax revenue collections. Now, of course, we know, I'm sure, you know, we will all agree on this point that what we need to reduce the deficit is to manage the spending side of the budget, not to increase the tax revenue side of the budget. But okay, but we are not the policymakers here. The policymakers, for whatever reason, various reasons, are more reluctant to cut the spending, and they might sometimes be more inclined to push the revenue. But I must say, I think that's one encouraging feature that we saw from this year's budget speech, is that this finance minister seems to be taking the tone of saying that they do want to indeed manage the spending side of things and then not push the revenue as much as perhaps might otherwise have been the case. Let's hope that they have success in managing the spending side so that we don't have to see these increases in tax rates, because ultimately it's really going to come through mainly with your personal taxes. You see, corporate tax, there's so many other variables that come into this, looking at multinational comparatives and so on. With the VAT rate, there's all the social issues in terms of that being a regressive tax. And of course, government has an election coming up. Do they really want to increase the VAT rate? And so when we take all of that into account, if they were going to push for additional revenue, unfortunately, we're going to see it, yeah, we can see it coming through fuel taxes and excise duties and that sort of thing, and specific excise duties, sin taxes, and we see it coming through on the personal tax side. And I think that's why we all heaved a big sigh of relief as far as the personal taxes were concerned this year, that we didn't see specific increases there. But even though the fuel levy is not increasing this year, going across to the green side over here, we are seeing quite a lot of these other taxes increasing. And I'll give you more detail on that as we go along. Right, so another important feature before we get to the detail of the tax changes is, of course, looking at tax collections. Now, this I actually took from the SARS statistics, and here they actually report on their cost of tax collections. This is a very important measure. It's kind of like, how much do you pay by way of fees when you put money into a retirement fund, you know, because I mean, that kind of goes into the system. So when your tax is collected, how much disappears by way of collection cost? Well, South Africa's percentages are actually, compared to internationally, I mean, you never want this to go anywhere close to 1%, right? Certainly not over 1%. And going back to 2017, it was 0.93. And then we saw a nice downhill trend coming through here, all the way down to 0.8, which looked wonderful. But then suddenly this year, we see it kicking up to 0.85. And I think that is quite a concerning thing here. Is this with SARS boosting their capacity once again? Is it with their investment in developing technology, which we all know is very expensive but necessary? But nonetheless, we don't want these things to push this any higher than this. So I think we need to watch this and just make sure that the cost of revenue collected doesn't go higher than what it is now. Hopefully, it could even be managed to become more efficient. I mean, that's the idea, right? As you use technology, things should become more efficient. But of course, we also know that implementing technology is extremely expensive, initially at least. Okay, so it will be interesting to see what happens with the cost of tax collections, and it is something that we need to keep an eye on. But let's then move on to the budget highlights and have a look at the specific highlights in more detail to see exactly how this is going to work and what is the impact going to be on your businesses and on your personal finances. So the announcement around the corporate tax rate coming down to 20%, but be very careful about the year end here. This drop from 28 to 27% is for years of assessment ending on or after 31 March 2023. Okay, so if we took a 12-month year of assessment, that would indicate that that's years of assessment commencing on or after 1 April 2022. So it's not too far down the line, but it's certainly not going to help any company that has a year of assessment ending February 2023, or even technically right up until 30th of March 2023. But for a year of assessment ending from 31 March 2023 onwards and thereafter, then of course the 27% will apply for the whole of that year, indicating that when you make your provisional tax payments during the course of the year, you will be using for that 2023 year, but remember it's March 2023 onwards, then you'd be using the 27%. So if you have a February year end, this 27% is not going to be there for your February 2023 year of assessment, but it'll come in for the following year. Okay, so just be careful about that in terms of your budgeting and planning, that you bring this into account in the correct year. Now, this wasn't a total surprise, although I must say for me personally, I was a little dubious as to whether they were actually going to implement it. Although some people say they promised it to us. I'm not sure it was an actual promise, but it was a statement in the last year's budget speech to say they would look at reducing the corporate tax rate to 27%, coupled with these tax-based broadening measures. Even going back to 2020 budget speech, they indicated their sort of commitment to reducing the company tax rate. And the reason why they did that is because of our corporate tax rate, as I mentioned earlier, being quite substantially higher than our trading partners and certainly other countries around the world. So the OECD average at that stage being sort of about 20-21, and now it's sitting at about 22 or 23%. So still lower than our 28% or even our 27%. Okay, so this reduction, I'm sure very welcome. I'm sure there's no one who would argue that point. But I think what we must bear in mind is that this is not necessarily going to lead to a reduction in corporate tax revenue, because this reduction in the rate is going to be offset by these two tax-based broadening measures. So these are two amendments that have been made to the legislation, which will broaden the tax base. In other words, it'll bring in more tax revenue. especially the one, more so the one than the other, I think. Well, in terms of the general spread, when it comes to the concentration of the rand value of additional tax, that's another matter. But there will definitely be more companies that are affected by the assessed loss amendment than by the interest limitation amendment. And I'll explain why as we go along. But what I must also highlight before I get into these specific amendments is that these are indeed amendments that have already been made to the legislation. If you were following my year-end update last year, you will know that we spoke about these amendments in my year-end update because they were part of the taxation laws amendment. At that stage was a bill, now it's become an act of 2021. So that is the act that was already promulgated in January this year. And so this legislation is already promulgated. The only thing is that in the act, in the 2021 Taxation Laws Amendment Act, the effective date of these amendments was given as they will take effect from a date when the minister announces a drop in the corporate tax rate. Now that the minister's announced this drop in the corporate tax rate in his budget speech, these amendments certainly will take effect. So they will take effect for years of assessment ending on or after 1 March 2023. Now let's just have a look at the corporate tax rates before we get onto those amendments. So with a corporate tax rate of 28%, the effective tax rate on companies, now this is the maximum effective tax rate pretty much because this is assuming a corporate tax rate of 28%, whereas of course small business corporations might have a tax rate lower than that. And we're also assuming that all after-tax profits are distributed by way of a dividend and that all of those dividends are subject to dividends tax at 20%. All right, which is not always the case. First of all, not all of the company's profits are always distributed as a dividend. Secondly, not all dividends are subject to dividends tax. And thirdly, even if dividends are subject to dividends tax, it's not necessarily at 20%, okay, because there's different variables that can come into play. If you have a company with a shareholder that is itself a resident company, dividends going from company to resident company would be exempt from dividends tax. Okay, so you're not always going to get dividends tax at 20%. But in the scenario where we have a full distribution of profits and all dividends are subject to dividends tax, with a 28% tax rate and a 20% dividends tax rate, we have an effective tax rate of 42.4%. With that company tax rate dropping down to 27%, that would mean for every 100 Rand of profit, you pay 27 Rand in tax, you're left with 73 Rand available to distribute as a dividend, on which you pay 20% dividends tax. That's 14 Rand 60 dividends tax. So total tax on those profits by the time the profit reaches the shareholder is 41.6%. Okay, so a drop of 0.8% once that 27% tax rate comes in. All right, so just an interesting one because that's a useful comparison when we compare that to the maximum marginal tax rate on individuals, 45%, or indeed the tax rate on trusts, 45%. We see that there is an ever widening gap between those numbers. I mean, I hesitate to say one way of narrowing that gap, if indeed government wanted to do that. Well, of course, one good way of narrowing it would be to drop the personal tax rate. Okay, but in the absence of that, the other way of narrowing the gap is to increase the dividend tax rate. They haven't made any mention of that at this stage. So we assume that we will be progressing on this set of tax rates going forward. Now let's dig into these actual tax-based broadening measures. So the two of them, the one being the amendment to Section 20, looking at the restricted use of assessed losses, and the other one being the amendment to Section 23M, which is the interest limitation provision. As I say, these are amendments that already exist in the legislation. If you pick up a copy of this year's Income Tax Act updated with the 2021 amendments, you will see this featuring, except if you pick up an act that has been published, let's say by LexisNexis, it's going to be in a little gray block because it'll tell you that, you know, it hasn't been activated yet. It's still going to come into effect. I'm just doing it into my legislation as I'm talking to you. But the Section 20 amendment on assessed losses. So what it is saying is that Section 20, whereas previously any assessed loss at the end of one tax year could be carried off and set off against taxable income in the following tax year without any restriction, and indeed no time restriction either. So going forward, once this amendment becomes effective, and that will be effective for years of assessment ending on or after 31 March 2023, at that stage, your assessed loss carried forward and then to be set off against that year's taxable income will be limited to the higher of 1 million rand and 80% of taxable income. So this was already in the legislation. As I say, if you saw my year-end update at the end of last year, you would know that this is indeed the case. So the higher of 1 million rand and 80% of taxable income. The reason why they introduced the 1 million rand in there is that effectively gives you an exemption for smaller businesses, all right? So if you have a smaller company that has an assessed loss of 1 million rand, then basically they would be able to offset the whole amount of 1 million rand because it's a higher of 1 million rand and 80%. So if you had an assessed loss of 1 million rand and in the following year you had taxable income of 500,000 rand, 80% of 500,000 is 400,000 compared to 1 million, the higher is 1 million. So you'd be able to set off the whole 1 million rand assessed loss. Okay, so it does give some relief and in fact, an effective exemption for small businesses. And if you look at what the Minister of Finance stated in his budget speech, he said, so companies with an assessed loss balance that matches or exceeds their current year taxable income will need to pay tax on 20% of their taxable income. But smaller companies are more likely to struggle with cash flow and they will be exempt from the proposed changes. Well, yeah, there's not really proposed changes. Well, it's just the implementation date that is proposed based on the announcement of the change in the corporate tax rate. And I should just mention that that change in the corporate tax rate effective 31 March 2023 is in the draft bill that was tabled at Parliament on the day of the budget speech. So in that, it's the Draft Amendment of Taxation Laws and Revenues Laws Act, or bill it is at that stage. And so this amendment of the company tax rate is already in that draft bill. Okay, so it is pretty certain. It's not just a statement in the budget. But effectively, this statement here that smaller companies will be exempt, so it's not a specific exemption, it's exempt on the basis of this 1 million rand threshold, that any assessed loss up to 1 million rand, you can set off the whole amount of the assessed loss. So let's have a look at this example over here. If we have a company with an assessed loss brought forward, so let's say this company has a June year end. So we'd say at June 2022, it has an assessed loss of 2.5 million. And then in June 2023, they've got taxable income. So now this amendment is taking effect for years of assessment ending on or after 31 March 2023. So the amendment will have effect for this year ended June 2023. So if we've got taxable income for the 2023 year of 2 million rand before setting off the assessed loss, and then we've got an assessed loss brought forward from 2022 of 2.5 million, what we are allowed to set off is the higher, the greater of 1 million rand or 80% of the current year's taxable income of 2 million. So 80% of 2 million is 1.6 million. Take the higher of 1.6 or 1, obviously 1.6. And so we set off the assessed loss of 1.6. That, of course, leaves us with remaining taxable income of 400,000, which will be taxed at 27%. As far as your assessed loss is concerned, we had an assessed loss of 2.5 million from 2022. We are utilizing 1.6 million. And that leaves us with the remaining balance of assessed loss of 900,000, which we then carry forward to 2024. And then we would look at applying that against any taxable income for 2024, subject to the same limitation. So if we're going to say 1 million rand or 80% of taxable income, we would be able to set off, in this case, the whole amount of that assessed loss in 2024. Okay, let me just have a look at this question. So if the company has an assessed loss from 2022 and then another loss in 2023, would you be allowed to carry that over? Yeah, so those rules will still apply. So in this case, if we had an assessed loss of 2.5 million in 2022, and let's say we had an assessed loss of 2 million rand in 2023, then we would have a balance of assessed loss of 4.5 million rand that we would carry forward to 2024. Okay, so it's not limiting in any way the accumulation of assessed losses. When you've got 1 year's assessed loss added on to an assessed loss brought forward, that's fine. You just add that on and proceed. The only time this restriction comes in is when we're setting off a balance of assessed loss against taxable income. Okay, and also please note that this amendment only applies to companies. And that's because the amendment to Section 20, if you have a look at it in your legislation, you'll see that Section 21A, which refers to the setting off of an assessed loss, that's now been split into two parts. 21A1 that refers to companies, and then that contains, let me just go back to the previous slide, it has this set-off limitation rule over here. And then 21A2 talks to any taxpayer other than a company, and there we just have the same wording as we had previously. So it says any balance of assessed loss incurred in a previous year that has been carried forward from the preceding year of assessment may be set off against the income of the taxpayer. All right, so for people other than companies, it's a full carry forward and set off as we have done before. It's only companies that are limited by this set off. Okay, so with a limitation on the set off. Okay, so I hope that does explain to you how that limitation rule will work. And then just to bear in mind that this will take effect for years of assessment ending on or after 31 March 2023. I think just another point to just bear in mind is that for those years ended 31 March 2023 and onwards, obviously you've got your provisional tax payments that are going to be happening during the course of that year. The first one will be in September 2022, 6 months into the year end. And then, of course, the second one would be at the end of March 2023. That's the earliest possible timing of tax payments, provisional tax payments that will carry the 27% tax rate, okay? And then also when you're working out your estimated taxable income for the year, you would need to factor in this legislation that is going to limit the set-off of assessed losses. So if you were trying to estimate your taxable income for 2023, you can't just say, well, I'll have no taxable income because I've got this assessed loss brought forward. You would have to apply this loss limitation rule to estimate your taxable income. If you're doing your second estimate, let's say, you'd have to estimate it, being an idealistic now, but you'd be looking at this 400,000 as opposed to saying, no, it's nothing because I've got this assessed loss that is brought forward. Okay, so just bear that in mind that you need to apply these set of limitation rules when you're looking at your provisional tax payments, insofar as they affect your estimated taxable income. Right, so that's the set off of the assessed loss. And maybe just before I move on from that, just to make the point that this, of course, this limitation, it only applies to companies, but it does apply to all companies. Anything that is defined as a company, this loss limitation rule applies. So don't be misled by the statement that small businesses are exempt. Well, it's not specifically that small businesses are exempt, it's that the first 1 million rand of assessed loss is allowed to be set off without limitation. All right, but otherwise all companies are affected. So just watch out for that. Okay, so then the question to clarify, the 80% is based on the taxable income for that year and not on the value of the assessed loss. Yeah, so an important point to just re-emphasize there is, in my example, when I'm taking my 80%, I'm taking 80% of the current year's taxable income. All right, so it's 80% of the current year's taxable income before setting off any assessed loss. All right, so that's the current year's taxable income. It's not 80% of your assessed loss brought forward. Okay, 80% of the current year's taxable income. All right, so I'm not sure if there's any other questions on the assessed loss provision that you want to ask me before I move on. Otherwise, if you think of something, obviously you can just pop it into the chat box and I'll come back to it when we take a break. Okay, right, so I think just making the point that a lot of companies are going to be affected by that limitation of assessed loss rule, bearing in mind how many companies have assessed losses. And of course, look, a lot of them, the assessed losses are less than R1 million. So fortunately, they won't be affected. But for many companies with very significant assessed losses, they may well be affected. Okay, then we have a look at the Section 23M. Now, this provision has a much narrower application. It's a much more focused provision. And here again, I did talk about Section 23M when I did the year-end update at the end of last year. But Section 23M is not a new provision. 23M has actually been in the tax legislation for a few years, but it has been updated from time to time. And so what we saw coming through with the 2021 amendments is that we saw 23M being changed to make it more restrictive. All right, so it is an interest limitation provision, and so it limits the amount of interest that may be deducted in certain circumstances, but it doesn't apply to all interest paid to every creditor. It applies specifically where there is a controlling interest and the interest is not subject to South African tax in the hands of the creditor, the person who's receiving. So the person paying the interest, the debtor, is looking at the interest deduction. The person receiving the interest, we're saying, is not subject to South African tax on that interest. Okay, so if it is subject to South African tax, then you would not be subject to this limitation. There is a specific proviso that talks about where it might not be subject to South African income tax, but it is subject to withholding tax. And there, if you're paying withholding tax less than 15%, then there's an element of exposure to this 23M limitation. But otherwise, if you're paying tax to somebody else, even if there is a controlling interest, but it is taxed in the hands of the recipient, then 23M is not going to limit the deduction for the person who is paying the interest. Okay, so it applies when there's a controlling interest and the recipient is not subject to South African tax. And when we talk about controlling interest, the definition of a controlling interest there, it means a relationship where one person, basically alone or together with connected persons, holds at least 50% of the equity shares or voting rights or participation rights in a company. So at least one of those persons must be a company, because I mean, you can't hold shares in something that's not a company, right? So one person must hold at least 50% of the equity shares in the other person, which is the company, or 50% of the voting rights or participation rights in a company. So one of the parties must be a company. Doesn't matter which one. It just talks about a controlling. Oh, sorry. No, I'm trying to delete something on my screen here, and I'm ending up doing all sorts of funny things. But anyway, okay. So it doesn't matter which party holds an interest in the other. It simply says that between the debtor and creditor, there is a controlling relationship. All right. There is a controlling interest or a controlling relationship. So one must hold at least 50% in the other. And then, of course, the person receiving the interest is not subject to South African tax on that interest. So once you're through the door, if Section 23M indeed applies, then we are into all of these amendments. And there are quite a lot of amendments to 23M that happened during the course of last year. And all of these amendments basically take effect for years of assessment ending on or after 31 March 2023, because they are effective the same date as the change in the company tax rate. So the way that they expanded the impact of Section 23M, remember it's tax-based broadening, we're reducing the interest deductions even further. So we first of all expanding the definition of interest, the interest that comes into the scope of Section 23M, and it talks about interest incurred under an interest rate agreement referred to in Section 24K. It talks about finance cost element recognized for purposes of IFRS in respect of any lease arrangement that constitutes a finance lease. It talks about exchange differences that come through Section 24I, and it talks about interest deemed to be interest under Section 24J. And it includes your normal interest under Section 24J as well. Okay, so it has an expanded definition of interest. And then the actual limitation on the interest deduction. Previously, it was set at 40% of this concept of EBITDA, the tax equivalent of earnings before interest, tax, depreciation and amortization. So the tax equivalent of that is taxable income before deducting, or indeed adding, because it's net interest, before net interest and capital allowances, and of course before setting off any assessed losses. Okay, so, and in the case of mining companies, before setting off any capital expenditure. All right, so it used to be set at a 40% threshold, but now it's going to be capped at 30%. And then what they've also introduced is that this limitation will apply in multinational groups, although what would be happening here is that the South African debtor would be paying interest to the non-resident creditor, and even if it's not subject to South African income tax, it's very possibly subject to the withholding tax, and they give recognition for that withholding tax. As I say, it's only if you're paying withholding tax at less than 15%, then we would be saying that it's not subject to full South African tax. Then there's a refined inclusion of back-to-back loans, and they have expanded the application to real estate investment trusts. All right, so these are all amendments that were made during the course of 2021 to this Section 23M limitation. As I say, it's not a new limitation, and it also has fairly limited application in that it applies where there's a controlling relationship or a controlling interest, and the recipient is not subject to South African tax. All right, so if the interest on the shareholder's loan is paid to a pension fund, Section 23M will apply. Well, no, not necessarily, because the pension fund, yeah, would be exempt, but would there be a controlling relationship? I doubt it, all right, because the pension fund, yeah, it's unlikely to be a 50% holding in the equity shares, etc. So it depends. I can't say categorically no, but remember that there has to be both the controlling relationship and the fact that, oh, you're saying it is a controlling relationship. Okay, interesting. All right, so if it is a controlling relationship and the recipient is not subject to South African tax, then yeah, Section 23M could apply. All right. But I think just have a look carefully at Section 23M, because it is a fairly complex provision. I don't want to state categorically because I don't know all the particular facts of that case. Sorry, Lauren. Sorry to be the bearer of bad news. But as I say, have a look at it carefully and just see. Don't just take my word for it, because I'm just answering on the basis of very flimsy information and without looking in detail at the various provisions. Okay. Yeah, so those are the amendments to Section 23M. And it's not to say you can't deduct any interest at all. It's just to say that the interest is going to be capped at 30% of the debtor, the person paying the interest. They're looking at the deduction. They're going to be capped at 30% of their taxable income before interest and capital allowances. But when they are subject to Section 23M, as I say, when it does apply. Another aspect I'm sure that might be of more interest to many of you is the small business corporation tax table. And so what we see coming through for years of assessment ending on or after 1 April, and that's ending, right, on or after 1 April 2022. I'm just suddenly wondering if I've got that date right, but yeah. So yes, so here we have the taxable income, the threshold is going up to 91,250, because that's always equal to the tax threshold for individuals under the age of 65. And from the 1st of March 2022 onwards, that now kicks up to 91,250. The rest of the table stays the same. And of course, we still have the 28% tax rate. But then for years of assessment ending, and it's quite confusing because they used to talk about commencing on or after, and now they're talking about ending on or after. For years of assessment ending on or after 31 March 2023, of course, we don't know what the threshold will be at that stage. Hopefully it'll kick up again. But working on the current information, all the rates will stay the same, except for this top rate will drop down to 27%, okay, instead of 28%. Okay. Just clear these questions that I've answered and the chat box. What happens if you're making losses with regard to interest paid to multinationals? So I assume we're referring to 23M here. So we're saying if you're making losses and you are in a controlling relationship and the interest is not subject to South African tax in the hands of the creditor, well, then you wouldn't be able to claim any deduction. Now, there is provision, though, that if you can't claim the deduction, that becomes a kind of a ring-fenced amount that is carried forward in its own right. It just can't create an assessed loss, but you would be able to carry forward the undeducted interest to the following year of assessment. Okay. Does the limitation of interest only apply to controlling interest? Yes. Okay, because if you have a look at section 23M, it does require that where there is a controlling relationship, okay, that's when it would apply. So let's clear that out. And then the other question, so not added to the loss, no. Okay, so it's not added to the loss. You're not going to increase the loss, because basically what you're saying is you're capping your interest deduction at 30% of naught, which is naught. Okay, so you can't get any interest deduction, but the excess then should be allowed to be carried forward. Okay, right. So let's go on then. So small business corporations we spoke about. And then the turnover tax on micro business, absolutely no change there at all. So another year goes by. I think this is now the third year with no change. So we still have exactly the same rates and thresholds that apply there. Then we go on to the next sort of highlight of the budget speech, and that's the increased employment tax incentive. So the announcement in the budget speech, and this is also reflected in the Rates and Monetary Amounts and Amendment of Taxation Laws Bill, which was tabled on the date of the budget speech, is that the employment tax incentive will kick up from the 1st of March 2022, which indeed was yesterday, right? So the way that the employment tax incentive is worked is that we calculate that as a percentage of remuneration paid to qualifying employees. And of course, when you look at qualifying employees, there must be people between up to the age of 29, etc. Now, of course, when you pay a remuneration of more than 6,500 a month, then you no longer get this incentive. So you claim a percentage of monthly remuneration, but up to a maximum. So this percentage, first of all, has increased. It was 50% of monthly remuneration in the first 12 months. And that kicks up now to 75% of monthly remuneration. So it's a 50% increase. 50% on 50%. Okay. And then in year 2, for the second 12 months, because it's only for the first 2 years that you get this incentive, first 2 years of employment of your young qualifying employee. So in the second year, you get now 37.5%, whereas it was 25%. Okay, so an increase in the percentage, but then also the maximum monthly incentive that you can get goes up from 1,000 to 1,500 for the first 12 months of employment, and from 500 up to 750 in the second 12 months of employment. All right, so quite significant increases coming through there. And what is also interesting is this statement that was made in the budget speech that talks about improved targeting of the incentive will be considered to support jobs for long-term unemployed work seekers alongside an expansion of the eligibility criteria for qualifying employees to improve the incentive for small businesses. Quite a tantalizing proposition there for small businesses. And this is about the only specific reference that we saw to small businesses in the budget speech. We sort of could forget about the fact that small businesses have such a vital role to play in economic performance and job creation, but at least it wasn't totally forgotten, because they are saying here that they are looking at expanding the eligibility criteria for small business. Now, it's looking at your definition of a qualifying employee. All right, so what we do see with the special economic zones that were in existence is that there they don't have an age limit. So for, generally speaking, as I say, the age limit is 29, but for companies operating in a special economic zone, they don't have an age limit. So I don't know, maybe they're going to look at something like that to raise the age limit if you're dealing with a small business. But of course, that'll also be linked to what is a small business. They'd have to give a definition of what kind of small business they're referring to there. But maybe they could give an enhanced incentive to even your small business corporations. I'm sure it'd be quite welcome. So you've got an existing definition and you can slot this into that section 12E, which already provides for enhanced capital write-offs on manufacturing assets and so on. So who knows, maybe they will do something along those lines, but it is quite pleasing to see that they are looking at expanding this incentive for small businesses. Okay, looking at tax incentives, of course, with some of the others is not such a good news story, because we see that 2 of our existing incentives are actually going to fall away. The allowance for rolling stock under Section 12DA and the special incentives for airport and port assets. So AXA obviously not going to continue with their incentive. So those incentives both have a sunset date of February 2022, and the statement was that those will not be renewed. So in line with the recommendations of the Katz Commission and the Davis Tax Committee, expiring incentives that have not widened social or economic benefits will not be renewed. So clearly it's those 2 there. Now, what we have seen is that the research and development allowance, that incentive has been extended to December 2023, and it's currently under review. So it might even go beyond that. It just remains to be seen whether it is producing the necessary outcomes. And if we jump down to the energy efficiency savings incentive, we see that that's been extended for another 3 years through to 2025. That's linked with the carbon tax rollout that I'll talk about later on. And then as far as your other incentives are concerned, there's no specific changes yet. Our learnership allowance already has been extended up to March 2024, so that's still in play. Special economic zones up to December 2030. Urban Development Zone allowance up to March 2023. And again, that will then be reviewed, and we will have to find out later on whether that's going to be extended. Okay, so it's just an interesting point around tax incentives. It's not a given that they would all keep rolling on indefinitely. Government definitely is taking a more critical view on this in terms of evaluating the outcome of these incentives, because every time you give a tax incentive, you're actually giving up part of the tax base. And so when you talk about protecting the tax base, part of that is being very careful about what incentives are given. All right, if you are going to give an incentive, it must be with a specific outcome in mind, and then you want to get some kind of return back on that. If you're getting that necessary return, or like with the employment tax incentive, they are generating additional jobs and so on, and government is satisfied that those outcomes are being achieved, then they will expand the incentives. But otherwise, no, they will switch off the tap, as you see they are doing with these 2 incentives over here. Okay, now let's go on and have a look then at individuals. So we've spoken quite a bit about corporate and business tax. With individuals, I mentioned about the across the board increase of 4.5%. So we see this coming through on all of our tax thresholds, and all the percentages stay the same. So that's quite a relief, I think, for most of us. I know for me, as soon as I opened the budget documentation on the day of the budget speech, first thing you do is go to the individual's tax table to see whether that number and these numbers down here are going to stay the same. So yeah, fortunately, these rates have all stayed the same, and we do see a little bit of relief being given for inflationary increases in salaries to alleviate bracket creep. And so we see all of these rand values increasing by 4.5%. Now, if we look at the rebates, we see also 4.5% increases. So our under 65, over 65, over 75, all increased by 4.5% over what was there previously. And so with an under 65, we have the tax threshold now going up to this 91,250. I pointed that out when you looked at the small business corporation tax table. And over 65 is a higher threshold, over 75 an even higher threshold, of course, because of their higher rebates that they get. Okay, so all of these adjustments, basically 4.5% adjustments. What is interesting is that it's a 4.5% adjustment compared to a CPI inflation, which was stated in the budget speech as being currently 4.8%, or at the time of the budget speech, 4.8%. So what we're actually saying is that these adjustments are slightly lower than inflation. It's not quite an inflationary adjustment. It's almost there, but not quite. And if you look back at last year, we had 5% increases to the rand amounts, the thresholds and the rebates, compared to inflation of 4.5%. So our adjustments there were slightly ahead of inflation. Now our adjustments are slightly lagging inflation. So anybody who gets salary increases above 4.5% would face the impact of bracket creep and fiscal drag, which means that effectively, you know, your salary, if you're sitting on, where should we pick a number, say 480,000, and you get a 10% salary increase, then obviously it's going to take you into the next tax bracket. Okay, so if you get a salary increase of more than 4.5%, then the adjustments to the tables is not going to help you. You could well end up going into the next tax bracket and paying a lot more tax. Okay, anyway, but you should be happy about the fact that you had an increase in your salary, so that should compensate for the, hopefully not always though, okay, it should compensate for the additional tax. Okay, now let's have a look at what was said around wealth. Now we know that there's been this ongoing focus on wealth taxes and high net worth individuals, high income earners. We have been advised that SARS has set up a high net worth individuals unit with a very well educated and experienced person heading up that unit. And so SARS feels that they are well placed to manage high net income individuals. And of course, what we always hear going on, especially around the budget speech, personally, it always puts me in a bad mood when I hear talk of wealth taxes, because I really do not believe that wealth taxes are going to answer the problem of inequality in our country. But nonetheless, we constantly hear talk of wealth taxes coming in. And although the statement in this year's budget speech was that they would not introduce a wealth tax at this stage, but what was announced is that they're going to be calling for this additional disclosure of information from your kind of high income taxpayers, but not necessarily on the basis of income, it's based on the type of taxpayer. So it's going to be required from all provisional taxpayers with assets above 50 million. It doesn't talk about net assets, it just says assets above 50 million rand, will be required to declare specified assets and liabilities at market value in their 2023 tax returns. Now, currently, of course, provisional taxpayers with business interests have to submit a statement of assets and liabilities with their annual tax returns. And that statement of assets and liabilities shows assets based on cost. Now going forward, they want to have this declaration with assets shown at market values, all right? And they say that they want this not just from people with business interests, but they want this from all provisional taxpayers with assets above 50 million rand. So I'm not suggesting that the current system is going to be replaced with this system. What generally seems to be the view of commentators is that this is going to be an expansion, not a replacement. So you'll still have the existing requirement of a statement of assets and liabilities based on cost from provisional taxpayers with business interests, but that will be expanded to also show market value in the case of taxpayers with assets above 50 million rand. The rationale given for that is to assist with the detection of non-compliance or fraud through the existence of unexplained wealth. Well, I mean, that's really the objective of the current statement of assets and liabilities, right? SARS would look at the movement in assets based on cost. And if your assets increase from, let's say, 2 million to 5 million, then they would want to see, okay, you've now got an extra 3 million rand of assets. How did you fund that? And is that coming through on your income tax return? Perhaps you got an inheritance as well, or maybe you won the lottery or whatever the case might be, that they should be able to explain the increase in the cost of assets. Now, the fact that they want here market values of assets clearly is feeding into the data collection looking at a wealth tax. I'm not saying that they're going to introduce a wealth tax, but I think what they're trying to do is that they're trying to get more accurate data on wealth. At the moment, our data on wealth is very scant. And I mean, we've got some economists who've done all sorts of wonderful econometric projections to try and work out wealth levels and how much wealth is held in what kind of assets and all that sort of thing. But we don't know for sure what these wealth levels are. And so this information, as they said in the budget, will help in determining the levels and structure of wealth holdings. And it was recommended by the Davis Tax Committee. So it's not necessarily saying it will definitely lead to a wealth tax, but it is giving government more data. And yeah, of course, I mean, it might pave the way to a wealth tax. I think it raises a couple of questions, well, quite a few questions. Let me mention a couple of them. So if we have to declare assets at market values, that's going to be quite a complicated exercise. Sure, if your assets are in the form of listed shares and maybe retirement fund interests, that's quite easy to work that out because your listed shares, you've got quoted prices and so on, and of course your retirement interests, or you've got portfolios and so on. You can get a statement and you've got your market values. Great, you can do that. But if you've got immovable property and or interest in an unlisted company, then it's very difficult to establish the market values of those assets. So that's point number one. Point number two is that these market values can fluctuate significantly from year to year. I mean, if any of you held Steinhoff shares, if you look from the year before the big events until the year after, I'm sure you would agree with that statement that the market values can shift significantly. It's one of the big problems with wealth taxes, if you're going to do an annual wealth tax, is that wealth is very fickle and it can move significantly from one year to the next. So if they want these market values in every annual tax return, that's going to become, I think, an unreasonable expectation in terms of compliance costs. So surely they must rather say that you need to update your market value, say every 5 or 10 years. Okay, so that's the other point. And the third point is, who's going to check on the accuracy of these market values? Because, you put a piece of some immovable property on the table, and now you want to establish the market value. Well, you still hold this asset. You only really know the value when you sell the asset. So it's quite difficult to say how accurate that market value is. So quite a few challenges in terms of determining the market value of these assets, and then how exactly is this going to be disclosed, and how is this going to be audited by SARS, and what are the implications going to be going forward? All right, so okay, so a few questions here. Is the 50 million at cost? Well, yeah, I mean, they say assets of more than 50 million. So I don't know at this stage. It's going to be interesting to see what they actually come in at. It would probably make sense to say 50 million at cost, and then of course you would then have to establish the market value. That's my guess, but we'd have to wait and see. Okay, so would this mean 2 balance sheets, one at cost and one at market value? Well, yeah, again, that seems to be what's being indicated, because I think SARS would still want to know the cost of these assets for the purposes of their reconciliation exercises. And then, of course, the market value in terms of perhaps helping them to project future capital gains tax collections. And of course, yeah, who knows, estate duty collections and that type of thing. So it would kind of be a logical thing to me to say that they would want both cost and market value. Market value for specified assets. They do say they're specified assets. Will the market value need to be provided by certified professionals? Well, you see, this is what worries me, is that if you're saying that you've got to have certified valuations done, this becomes a very expensive exercise. And you surely can't be expected to do that every single year. So one has to be a bit realistic, but certainly if they're going to introduce this in 2023, you've got to start somewhere. So you probably would need certified valuations. It's kind of a little bit like what we had when capital gains tax was introduced back in 2001, where we had to have specific valuations done, if any of you recall that scenario. So there probably would have to be specific valuations. Well, maybe you don't have to actually submit a certified valuation with your tax return, but remember the onus being on the taxpayer and so on if SARS challenges that market value. But this is where my other question comes in. What are the consequences of accuracy? So, how are you going to substantiate the accuracy, and will you need actual certificates? I think certificates, yeah, it might be if you feel that you need it, but we'll have to wait and see when they introduce the legislation. We need to look very carefully at what comes through in terms of the legislation here, and think very carefully about the practicability, the costs of compliance, and the possibility of further disputes with SARS. And how's that all going to work out in terms of these market values? Because, I mean, we all agree that market values can be extremely subjective, right? And as I say, you don't really ever know until you actually sell that asset, and then you know what the realization is. So I think the bottom line is that we need to look very carefully at this legislation to see what comes through, and we need to get involved with commenting on the legislation, because remember, if we just allow it to go through and then we've got to deal with all of these problems later on, it's very difficult. So let's rather use the opportunity to comment on the legislation and make sure that what comes through is as practical as possible. But I do anticipate that there's going to be a huge amount of pushback in terms of this proposal. People are getting very, very unnerved by this proposal about the fact that, is it really paving the way for a wealth tax? And, should we be disclosing this kind of information, and should we be imposing this kind of compliance burden on taxpayers? So I think, it's going to be quite a lot of pushback, but let's have a look and see when this draft legislation comes out. All right, so that's quite an interesting proposal. And then what's also interesting is this other proposal about reviewing the provisional tax system. So what was stated is that a review of the provisional tax system is being considered, given changing circumstances and international developments, with the intention of publishing a discussion paper on the subject. When we look internationally, some countries, especially with the advances in technology, and perhaps that's what they're talking about, we are seeing that increasingly we are seeing a sort of accelerated recovery of tax, that many times governments are not sitting around waiting for 6 months or a year, etc., for tax payments to be made, because the technology makes it possible to know with greater accuracy, more on a kind of a pay-as-you-go basis. So in some cases, we are seeing an acceleration or a more regular payment of these taxes. And perhaps that's what they're going to be working towards. I know even many years ago, I'm going back a decade now, SARS even at that stage was talking about making provisional taxes more frequent than 6 monthly. And they were talking about moving to a 3 monthly and possibly even a monthly system. And as I say, I'm going back a long time now, they were talking about that. So perhaps they're going back to that again. Certainly when you look at the SARS statistics with the tax collections, and you can get the SARS statistics on the SARS website, and they've got under the chapter that deals with their general collections, they indicate the collections that come through on a month-by-month basis. And it's quite interesting to see that it's very clear that, you've got the bulk of your payments that come through at the time of the provisional taxes and then on assessment. And it does kind of skew the tax collections quite a bit. So you have some months with quite low collections, and then you have really significant tax collections coming through, especially sort of December, which is, of course, the second provisional payments for your many companies, mining companies included. And then, of course, when you go to February and March, big collections coming through there. So it kind of makes the tax collections on a month by month a little bit out of kilter, and maybe they want to smooth that. Whether it's possible to smooth it, of course, remains to be seen. So we'll have to have a look and see. They're talking about publishing a discussion paper on this subject. So let's have a look and see when that discussion paper comes out. As I say, this has actually been in the thinking and discussion at SARS for a long time. Then, of course, if we move on to some of the other tax changes or not tax changes, interest exemptions, our local interest exemption unchanged. We know that this is very, very unlikely to change anytime soon, because some years ago when the tax-free investment system was introduced, at that stage it was Pravin Gordhan who was the Minister of Finance, and he stated quite unequivocally that the tax-free investment would overtake, that would be the means of giving incentive for savings, and this exemption would fade away. So they certainly would not increase it, and ultimately they would remove it. So at the moment it's still there, and I think we're all grateful it's still there. And then, of course, we have the non-residence interest exemption. That is 100% exemption for non-residents if they are physically absent from South Africa for at least 182 days in the 12 months before the interest accrues, and the debt is not effectively connected to a fixed place of business of that non-resident. Okay, then they get the 100% exemption. But of course, they do sometimes have the withholding tax on interest that applies, albeit at a rate not exceeding 15%. Okay, so the local interest exemption is still there, unchanged. Of course, we look at that together with the tax-free investments. And this, as I say, is the new focus in terms of incentivizing savings, although it is certainly becoming more popular than it was when it was first introduced. And we see that the annual threshold was originally increased from 30 to 33, then up to 36, but it then hasn't increased since 2020. I do think that's a bit of a shame. I think, government's missing a point here, that if you want to look at growing the economy, personal savings is a big part of a healthy economy. And I think to increase this, it's not really giving too much away, surely. and yet they have not increased it since March 2020. And yeah, so it still sits at a maximum of 36,000. And don't try and beat the system by putting in extra, because you end up paying a penalty if you invest more than 36,000 in a year. Okay, and of course the lifetime limit is 500,000. Right, then of course, as far as individuals are concerned, we get the monthly medical credit, where you are contributing to an actual medical aid scheme. And here we see, again, a 4.5% increase in these amounts. So for the member and first dependent, goes up from 332 to 347 per person per month. And for each additional dependent, a 10 Rand increase from 224 to 234 for each additional dependent. Okay, no change to anything else as far as that credit is concerned. And certainly the additional medical credit, there's no change there either. There's no fixed amounts involved there. It's just on a percentage basis. Then if we look at these subsistence allowances, so there was a draft notice that was published on the SARS website just after the budget speech. And here we see that the daily rates will increase from the 1st of March. It was 452. In fact, it was not increased last year. It was the same 2021 and 22. It was 452 per day. But now it's going to go up to 493 per day from the 1st of March for this current tax year that we are now in. And if your allowance is going to cover incidental costs only, then it's going to go up from 139 to 152 per day. For travel within the Republic, and that's where a person is traveling away from home for at least one night for business purposes, and they are paid an allowance by their employer to cover these costs. So they're then deemed to have expended this amount per day. So this is kind of your tax-free amount. All right, now if they travel outside the Republic, your deemed expenditure is on the basis of the foreign currency. And here we are looking at a notice that was published in 2019, and there's been no change since then. So I think they're assuming there's no inflation in countries outside South Africa. And I say that a little bit tongue-in-cheek. But of course, what we do see is that these foreign amounts are translated through to rands using current exchange rates. So at least you get that current element coming in, but certainly the foreign currency amounts will remain as they have been since 2019. What we do also see is this change that came in effective 1 March 2021, and this talks about a per day rate, where a person travels away, not overnight, but just for a part of a day. They're traveling away from home, and they get an advance or a reimbursement of expenditure. And there your daily rate is 152. It's in line with your rate over here for your incidental costs, 152 Rand per day, right? So this per day rate, the subsistence rate for day trips, also 152 per day. It was 139 per day. Now, interesting, just to pause there, is, so then my next slide would normally be the new travel allowance table, but SARS hasn't published that yet. So I had another look this morning, and I see they still have the old travel allowance table. So yeah, they do indicate watch the space, the new table is coming. So I'm sure it will be published soon, but at this stage, I don't have the new table. As far as working from home is concerned, this of course became a very big issue when people were finalizing their 2021 tax returns, and they were all, I think, having all great expectations about all the expenditure that they could claim as a tax deduction, only to hit the reality that actually the rules are pretty tight as far as home office expenditure is concerned. Of course, you've got section 23B that says that you can't deduct any personal private expenses, except that where you have a portion of your home that is used for trade purposes, but it must be specifically equipped and regularly and exclusively used for business purposes. And then you can deduct the costs of the premises that relate to that part of the home that's used for trade purposes. Now, with employees who are subject to section 23M that says you can't deduct anything other than certain specific deductions, but of course, that they do cater there for your home office expenditure. But it's very limited in terms of what people can deduct. And it did create quite a lot of unhappiness. I don't even know what the stats are right now. The last I heard is that something like 80% of the claims for home office deductions had been declined by SARS. I think every single one of them went for audit, and some people are still waiting for the outcome of the audit, and others have been had some of their expenses disallowed. Yeah, I think because many people just didn't fully understand the legislation and perhaps were claiming expenditure that they would never have been entitled to. Okay, so the issue is that there was a lot of confusion around tax treatment of expenditure incurred when people are working at home. And so in 2021, last year's budget, National Treasury already indicated that they would review this whole issue around home office expenditure. And they said that they would have a multi-year project starting with consultations during 2021/22. So that presumably is underway. I mean, SARS has been putting out quite a lot of information around this. They've opened a special section on their website dealing with your home office expenses. They ran a couple of webinars to try and educate people. But certainly no changes have been made to the legislation. And they didn't say they were going to make changes to the legislation, of course, and so they certainly haven't made any changes. What they've said in the 2022 budget is that they will publish a discussion document sometime this year, looking at a personal income tax regime for remote work. So not specifically home office expenditure, but remote work in general, which might even mean if you want to go and work in the Caribbean or something. Okay, but remote work could incorporate all sorts of different things, that they are looking at a document on that. So they're not specifically saying that they're going to change anything in the legislation. I think much of it is an awareness thing, that people are more aware of what the tax treatment is, what they can claim, what they can't claim. And actually, what should happen with much of this expenditure that people incur when they're working from home is that they should be recovering those costs they should be recovering from their employer. And to the extent to which they're recovering costs from the employer, there would be no tax implication for the employee, and the employer would get the tax deduction as part of the cost of business. So that would be a far better way of dealing with much of this. But of course, that doesn't cover every situation. And so there's still quite a lot of confusion and unhappiness around the tax treatment of home office. I see also on the SARS website that they have updated their document relating to the deduction of home office expenses. They've updated it again. So you might want to go in and have a look on their What's New website and pick up that updated document that gives more explanation around claiming home office expenses. Another aspect of individuals' tax, and this talks about the timing of the taxation of remuneration, and that's section 7B that applies specifically to variable remuneration. So this is a specifically defined term in section 7B. And what section 7B tells us is that when you've got a person who earns variable remuneration, the time at which they are taxed on that income is not at the time that it accrues to them, but it's at the time that it is actually paid. And if you think back to the history of section 7B, it was introduced after there had been quite a lot of confusion, especially with remuneration paid to directors of small companies, or where there was a profit share, or there was some sort of commission linked to the profits of a company. So you would get to the year end of the company, and this bonus or the profit share, etc., would be payable. It has accrued to the person, but you can't quantify that amount at that point because you don't yet know what the profits of the company are. There'll be some months later, maybe even a year later, that you actually are able to determine what the profits are. And that led to some confusion around the timing and the incidence of employees' tax and so on. And so section 7B just created this deferral rule to say, okay, if it's variable remuneration, we won't tax it when it accrues, we'll tax it when it's actually paid, because then there's no issue around knowing the amount. Okay, by the time you pay it, you know the amount, so we're going to tax it at that stage. But the other side is, of course, that the employer only gets the deduction when the amount is paid as well. So the whole tax incidence moves to the time of payment. And it all hinges around this definition of what is variable remuneration. So variable remuneration is defined in section 7B, and it includes overtime pay, bonus, commission, allowance or advance relating to transport expenses. Leave pay is covered as well, any night shift allowance, any standby allowance, and any amount granted in reimbursement of expenditure as contemplated in section 8182. All right, so at the moment, we've got those 7 little sub-paragraphs that tell us what variable remuneration is. But now the concern, and before I move on, let me just mention that we did already see that amendment coming through in 2020 that expanded that definition. So there were some extra things that were added on in 2020. They added on the night shift allowance, the standby allowance, and the reimbursement amounts, okay? But now they've said that actually that definition still doesn't fully cater for all types of variable remuneration. And they specifically looked at the informal sector where there's payments based on units produced. And they said that this definition of variable remuneration, when it talks about commission, that commission is really contemplating a commission based on turnover or some kind of income that has been produced. It doesn't look at volume of units produced. And so they want to adjust that definition to bring in this kind of remuneration as well. So that's going to be an amendment that comes through, just broadening, adding another little paragraph into that definition of variable remuneration. Okay. And then also affecting individuals. And here we go back to this issue that we've focused on for a number of years now, when people cease to be a resident. And I think you are familiar with the point that comes through section 9H, is that not only is there deemed disposal of assets, the time when a person ceases to be a resident, but also the year of assessment is deemed to end on the day before they cease to be a resident. And then they've got a new tax year that starts from the time that they cease to be a resident. Okay, so if a person ceased to be a resident on, let's say, the 1st of October, 2021, they would have a year of assessment that ran from the 1st of March to the end of September, 2021. That year of assessment, the person is taxed as a resident. Then they cease to be a resident from the 1st of October, so they have a new year of assessment that starts from the 1st of October, runs through to February of the following year, and for that year of assessment, they are taxed as a non-resident. Now, the issue is that when we've got the interest exemption, remember the interest exemption can potentially apply to both a resident and a non-resident, although I did mention that non-residents have a full interest exemption, but it doesn't always apply. Remember that 182-day rule. All right, so if they don't get the full interest exemption, then they would be looking at this fixed interest exemption, the 23,800 or the 34,500. That's the interest exemption we're talking about, that local interest exemption, the fixed amount. Now, the CGT annual exclusion is the 40,000 Rand per annum annual exclusion that applies as far as capital gains are concerned. So those amounts, those fixed amounts, the 23,800 and the 40,000 annual exclusion, apply per year of assessment. So technically, if you have 1 year of assessment running to the end of September, you could get an interest exemption of 23,800 and the annual exclusion of 40,000. And then you've got a new year of assessment that runs from the 1st of October through to the end of February the following year. Technically, you could get that exemption and that annual exclusion again, which is unintended. It's not intended that you should be able to get double because you have 2 years of assessment in one. And so they've said there that the proposal is that they want to apportion the interest exemption and the capital gain, similar to what we do with a rebate when we apportion a rebate for part of a year of assessment. I would assume they're going to take the same approach when you look at this interest exemption and the CGT annual exclusion. And they're only going to do that, they've indicated here, when an individual ceases to be a resident. And it's really to prevent this duplication where you could get 2 exemptions or 2 annual exclusions effectively within the same 12-month period, just because you have 2 years of assessment within that 12-month period. Okay, just closing off until we take a little break, let me just run through the UIF. So as you will remember last year, the UIF remuneration threshold increased on the 1st of June 21. We haven't had any further announcement around a new increase this year yet. I'm sure it probably will come. But the skills development levy, also no change. I don't expect that to change. Our annual remuneration threshold at 500,000, and of course the rate being 1%. We're not expecting any change there either. In terms of your retirement fund tables, those all stay the same. So your withdrawal benefits, your retirement benefits, and your lumps, your death benefits, those all stay the same. Same tables, they haven't changed at all. Also, the foreign employment income tax exemption, the amount of 1.25 million unchanged. So no further change as far as that's concerned. And then just as far as the bursaries are concerned, remember from March 2021, there was the amendment that said that the exemption will not apply if there's any element of a salary sacrifice. All right. Otherwise, the exemption applies subject to certain thresholds, and none of these thresholds have indicated that they're going to change. So we still have the remuneration threshold of 600,000, these exemption limits that apply for school or post-school education, and for persons with a disability, they've got this higher exemption limits. Okay, so none of those are proposed to change. So just to make that quite clear that there's no change to any of those numbers. And then with donations tax, no change on donations tax. So that all exactly the same, and estate duty all exactly the same. So I think many people are quite relieved there. I think there was a worry that the donations tax and estate duty rates could increase, especially with all the talk about wealth taxes and so on, and the talk about needing additional tax revenue. But I think thanks to the windfall, any possible increases there were put on hold. Just to close off the CGT maximum effective rates, of course, you know how these are calculated. We take the inclusion rate multiplied by the maximum marginal rate to get the effective rate of CGT for individuals, companies, and trusts. And companies, of course, it's just to look at two rates, the one where we've got a 28% company tax rate, and then once the company tax rate drops down to 27%, we still have the inclusion rate at 80%, which is interesting as well, that they haven't increased that. It's still at 80%. And then taxed at 27% gives us an effective rate of 21.6%. All right, so the decrease there coming because of the decrease in the company headline tax rate. Transfer duty, absolutely no change there. So we see since the 1st of March 2020 that the transfer duty table remains unchanged. Okay, so just this question, then we'll take a break. For foreign employment, if your contract overseas starts November to November of the following year, do you qualify for the exemption? So what would happen? Yeah, so the idea is that you're looking at remuneration earned outside South Africa, as long as you're outside for the required period of more than 183 days, of which more than 60 days must be a continuous period of absence. And then that remuneration would be exempt up to the limit of 1.25 million. So then the portion of the remuneration that falls from November, January, February of year one would be exempt, and the portion in year two. Okay, so you look over this 12-month period that crosses into the tax year. And if you meet all the necessary requirements, then you would get the exemption. Yeah. Okay, so that's a good time to take a break. So it is 14:36. So we'll take a 20-minute break, and I'll see you back at just before 5 to 3. Okay, 20-minute break, and then I'll see you back just now. Thanks then. Right. Hello, everybody. Are you ready to continue? If not, speak now. All right. Otherwise, we will carry on. We're going to carry on. Yeah, great. Thank you, Stan. I assume that means that you're happy to continue. All right, great. I see that Stan had a question around the transfer duty table, but indeed that 1.026 million is correct if you do the calc. You can see and validate that. Then Ian made a comment, which is a very valid comment, is that when we had a BHP Group unified the dual listed structure, PLC shares were converted into BHP Group Limited. So just share conversions, which gave rise to a CGT event. Yeah, and in other countries, there was a rollover relief. Yeah, I think this is one of the problems, I think, in South Africa, is that perhaps with all of these corporate actions, we need to pay more attention to the CGT rollover provisions. I mean, yeah, you know, there is some rollover relief available with corporate restructuring and so on, but obviously it doesn't apply everywhere. And clearly there are gaps where perhaps it should apply and it's not applying. So yeah, very good comment. I think maybe that's something that, Ian, I would really recommend you take up with SAICA, because they will have people who are working with SARS and National Treasury commenting on the proposed legislation. And also this is a policy issue that I think should be brought in maybe to be addressed in the future. So I do think perhaps just direct it to the guys at SAICA, the people at SAICA, not just guys, ladies too. Okay. And then Jerry asks a question about foreign employment income. Do you have to declare it? Yes, definitely. And yeah, I mean, there is, when you set up on the wizard, you would indicate that you have foreign employment income and there would be a place to declare it. Okay, then going on to the specific excise duties. So sin taxes, and this applies, of course, to alcohol and tobacco. And what we've seen here is increases, well, they say between 4.5 to 6.5, but I see 5.5 to 6.5. And new developments basically looking at beer powder, which there has been no increase on the excise duty on beer powder for many years. But what they've noticed is that there's other equivalent products who are off the radar screen, and they want to bring those in and put them subject to this levy as well. And that'll be from the 1st of October, 2022. And as far as vaping is concerned, well, we've heard talk about taxing vaping for so long. I'm not quite sure why it has taken so long. But they are proposing to apply a flat excise duty rate of at least R2.90 per milliliter, both nicotine and non-nicotine solutions. And that will come in from the 1st of January, 2023. So vaping will then be included in this table of excise duty rates, which is quite long already, as you can see there. I've just put it in there because everybody always wants to see what they are specifically paying on their product of choice. And what you can see here is that the increases, well, no increases, as I say, has been the case for many years for traditional beer and beer powder. But then other increases between 5.5% and 6.5%. So generally 5.5%. But then on your kind of products, which really, if you talk about wealth taxes, and a lot of commentators and academics and so on, economists will talk about when you tax the wealthy, you should tax them on their consumption, because that's really where you're going to be able to get the additional taxes coming through. And maybe this is part of what we're doing here, is that sparkling wine, you see a higher percentage change coming through there. Spirits, so your brandy and who knows what all comes in there, also 6.5%, and then going down to cigars, all right, also 6.5%. So you're kind of more, yeah, the kind of products that will appeal often to your high income earners are getting the higher percentage changes. And for the rest of us, just the 5.5%, and then of course 6% on pipe tobacco. Okay, so just interesting to see how those changes are coming through. And of course, all of those changes would have happened from the date of the budget speech. They would have come into effect immediately. So it's too late to rush out now and try and get something at the old rate. Then, of course, the health promotion levy, or sugar tax, as it's more commonly referred to. And sugar tax applies to our sugary drinks currently. So if you want to see whether you're paying sugar tax, just pick up the bottle of whatever it is that you like to drink, Coca-Cola, or maybe some fizzy drink from Woolworths or whatever the case may be, have a look at the product label and you'll see there the sugar content. And if the sugar content exceeds 4 grams per 100 milliliters of liquid, then you're paying sugar tax on the excess. All right. So it was introduced in 2018, increased in 2019, stayed the same for 2 years, and now it's due to go up again on the 1st of April 2022, and it's going to go up 10 cents per gram in excess of 4 grams per 100. All right, so there will be additional sugar taxes paid from the 1st of April, but here again, this is one of these stealth taxes that don't sort of hit you front and center. They come through the price of goods. And so if you're still buying sugary Coca-Cola, Fanta, Sprite, whatever the case may be, you'll pay these additional sugar taxes on the price of those products from the 1st of April 2022. And then notice here that they've indicated that consultations will also be initiated to consider lowering the 4 gram threshold and extending the levy to fruit juices. So actually to expand the scope of sugar taxes. So to make it even more hard-hitting than it is already. I think what happened with many of these commercial drinks is that following the introduction of the sugar tax, that's when we saw all of these different variations coming out, sugar-free, etc. And so many of these drinks don't actually have sugar. They are sweetened with artificial sweeteners, so thereby avoiding the sugar tax. Nonetheless, there has been a reasonable collection of sugar taxes in the last few years. But of course, at what cost? If we look at the representation made by the South African Cane Growers Association, they've made extensive representation to government, asking them to scrap the sugar tax because of the negative impact it's having on the sugar industry, which in some cases is your small, developing, emerging farmers and so on, who are planting sugarcane, but now, of course, they are seeing that their market is disappearing. And so there have been calls saying to government that this is impacting the economy to a huge extent and causing a massive loss in revenue for significant parts of this cane growing industry. Nonetheless, government has paid no heed to that. And as you can see, they're certainly not scrapping this. They're actually expanding on this tax. So they're obviously on a mission and they're going to be increasing sugar taxes going forward. All right, then fuel taxes, interestingly, no increase in fuel taxes this year. And the statement was to support consumers and the economic recovery. No increases will be made to general fuel levy on petrol and diesel, providing tax relief of 3.5 billion. Also, no increase in the road accident fund levy. Now, well, of course, what we have seen instead is, as of midnight last night, a massive increase in the fuel price. And it looks like that could happen again next month. So actually, this keeping the fuel levy fixed is not really helping consumers because the actual price of petrol is running rampant at the moment. But what you also are seeing, although the fuel levy and the accident fund levy and so on stays the same, there is a carbon fuel levy which is increasing slightly, just by 1 cent per litre. So there is a slight increase coming in from the 1st of April, just 1 cent per litre, but for the rest, all of that is staying the same. And it remains to be seen what happens next year. It looks like there's quite an outstanding report from the Road Accident Fund in terms of their financial situation. So whereas they've chosen to keep this fixed, who knows, once all of their financial information comes to light, if indeed that happens in the next year, we might see a significant increase there. But they're also looking at revising perhaps how all of this is actually working. So for the time being, it pretty much all stays the same. And then we look at another environmental tax, which is on the rise, and that is carbon tax. And what we saw is that carbon tax came in June 2019. Now, carbon tax was never intended to suddenly produce massive amounts of revenue. Carbon tax is a tax that is there to change behavior. And the idea is, of course, to try and change methods of production to cut down on carbon emissions. And this is part of a much bigger agenda because it actually ties into the Paris Accord and all the work that the United Nations is doing in terms of sustainability and managing fossil fuels and all that sort of thing. And so South Africa made certain commitments around managing carbon emissions, and carbon tax was part of all of that to try and change behavior, as I say, to try and reduce carbon emissions going forward. And so this is referred to as a long-term tax by National Treasury. It's not a short-term revenue generator. It's a long-term behavioral tax, if I can put it that way. But nonetheless, from the time it came in, the Carbon Tax Act had an inbuilt increase mechanism, which spoke about an annual increase being CPI plus 2%. And so every year on the 1st of January, we look back and see what was the CPI in the previous November, add on 2%, and that's the increase. So you can see January 2020, January 2021, January 2022, and we see the rate has gone from 120 to 127, 134, and now it's at 144 per ton of carbon. We are still in the first phase of carbon tax. This first phase was due to run through until the end of December this year. And the first phase has this kind of soft implementation. So it's getting people all used to this, how it works and so on. It's pretty complicated in terms of the mechanism of carbon tax. But we have this upfront rate per ton of carbon dioxide, and then that is offset by numerous allowances and so on. Now that in the first phase, that means that there's really not much carbon tax that is actually collected. But going on to the second phase and subsequent phases, that will change and carbon tax revenue will certainly increase. What they have done though is they've actually extended this first phase now for another 3 years. So it's going to go through until the end of December 2025, which means that the structure and the way that carbon tax operates will stay pretty much as it is at the moment, just with these annual increases. But the ongoing offsets with your tax-free allowances, etc., that will continue. But then comes the second phase from 2026 onwards. Then certainly they expect to see tax-based broadening, rate increases, and reductions in allowances, which will mean that carbon tax will become much more expensive from a consumer's point of view and generate a lot more tax as far as SARS is concerned. Okay, so it's certainly something that is here to stay and certainly will generate more and more tax going forward. Now, of course, some of these other aspects of environmental taxes, and for example, incandescent globe tax, which is a high energy producer. And so they had these environmental taxes that were introduced here. This was starting in 2009. This seems to be when this whole focus on green taxes and environmental taxes came to the fore, because we saw these taxes being levied on these sort of old-fashioned bulbs that use a lot of energy to try and encourage people to move over to lower energy solutions. And so you see the rate per bulb going up, and from 1 April 22, increasing again if you are still using these old-fashioned globes. Similarly with plastic bag tax, here this came in actually before, even in 2004. But remember back at the time that plastic bag levy was introduced, the idea was that all revenue generated from this tax would go to a special company, and that company would be involved in creating environmental awareness and managing recycling and all those good things. That stopped happening, and now the plastic bag levy just goes into the big pot with all the other taxes. And what we have seen is that this rate per bag has increased quite significantly and will increase again on the 1st of April. You see all of these stealth taxes going up on the 1st of April. So here we see it going up by more than 10%, from 25 to 28 cents per bag. There is a cheaper rate on those nice recycled bags that you get, the bio-based plastic bags. You pay a lower rate on that, but you still pay plastic bag tax on that, because ultimately that still leads to litter and so on. But what government has said is that they plan to reduce single-use plastics, upstream plastic tax, and the tax on single-use plastics will be investigated. So that's something further down the line. Certainly, I mean, from the time this was introduced back in 2004, there's been a lot of development around environmental issues, environmental awareness, different kinds of products that are available. So I'm sure it is due for an overhaul, and I'm not sure how long it will take, but they say that they are going to work towards upgrading this plastic bag levy. And then this environmental levy on electricity, this comes through your Eskom charges. And we see it hasn't really increased, but it's still sitting at 3.5 cents per kilowatt hour. And that's on energy generated from non-renewable sources, which is most of the energy in South Africa. And so, yeah, no specific change there, but nonetheless, that is an additional tax that we pay. Where we do see another change is with motor vehicle emissions tax. And I've put the whole history here just so that you can see from 2010 all the way down, passenger vehicles, double cabs. This is a tax that applies according to the rate of emissions. So your emissions above a certain amount. All right. So if you have a passenger vehicle that is emitting currently above 95 grams of carbon dioxide per 95 grams per kilometer, then you're going to pay a certain rate. And that rate is going up 10% from 120 up to 132. For double cabs, also a 10% increase from 160 up to 176. Okay, so certainly, again, another increase coming in through these environmental taxes. All right, then if we look internationally, of course, we have a range of withholding taxes that apply. And our rates generally apply at 15%. Of course, sometimes these can be lowered depending on whether there's a specific provision in a double tax agreement. But otherwise, we're still looking at 15% across the board. This last category is the Section 35A withholding tax that applies when you have a non-resident disposing of immovable property in South Africa. And there's an upfront payment of tax that happens as a withholding against the proceeds that are paid across. And so that applies at various rates, depending on the nature of the seller, individual, company, or trust. So no change there either. All of those tax rates stay the same. Okay. So then let's go on and have a look at the Annexure C proposed amendments. So Annexure C is our sort of more technical changes that are proposed. And we have quite a short list this year. I kind of wonder if there's probably going to be a lot of complexity coming through all of this, because I can't believe these are the only changes that are going to happen. Nonetheless, this is what we have been told. Well, of course, we also have the other things that I've already mentioned, like the review of the provisional tax system and all that sort of thing. But then we've also been told about retirement funds. Now, cross-border, and here we look in two different directions. So first of all, they're saying that they're going to review the exemption of foreign retirement benefits in domestic tax legislation. So this is when you have people who are now in South Africa and they are receiving pensions from outside South Africa. And we've got specific exemptions there under Section 10(1) GC. So they're obviously looking at reviewing that. They have been talking about reviewing this for quite some time, but it might well be that they're now going to really get onto looking at this, because at the moment, of course, any pension paid from a foreign social security system is fully exempt, and then any pensions from foreign retirement funds would be exempt from tax in South Africa. On the other hand, of course, last year we saw in the budget talking about people in South Africa who had built up savings in retirement funds and then ceased to be resident. So they then shifted and went and lived somewhere else. And in last year's budget, you will recall that they had proposed a type of exit tax on these retirement benefits when a person ceased to be a resident. And they put forward draft legislation on that, but it all came to naught because in the comment process, it was pointed out that if they went ahead with those amendments, it would amount to tax treaty override, which is a big no-no in terms of international tax. And so they then said, that, okay, they're going to shelve that. They'll have to go back and have another look. Now, the issue here is that when we have a person who has contributed to a South African retirement fund while they're living, working, earning in South Africa, and they're obviously getting tax deductions for those contributions into the South African funds, then they cease to be a resident. And then some years later, they then take that money out of the fund, either as a withdrawal benefit or as a retirement benefit. Now, the way that the South African tax works is once you are a non-resident, so you're no longer tax resident in South Africa, we tax you only on South African source income, right? But now in terms of our source rules in Section 9(2), any payments that go from a South African retirement fund are deemed to be from a South African source. Fine. So that means South Africa retains the right to retain those retirement benefit payouts. Even if they go to a non-resident, it's from a South African source. So we would have the right to tax those amounts, except that you then have to look at the double tax agreements that apply. And there are some double tax agreements that give exclusive taxing rights. In other words, only one country can tax those retirement benefits, and that exclusive taxing right is given to the country where the person is resident at the time that the retirement benefit is paid out. And that's where South Africa loses the right to tax those retirement benefits. So it's when there's a double tax agreement that gives the exclusive taxing rights to the country where the person is now a resident, not South Africa, the other country. And so the problem is that we have agreed to that when we signed those double tax agreements. And that's why if we went ahead with that proposed exit tax that was on the table last year, it would amount to that tax treaty override. We'd be overriding what we've already agreed to in the double tax agreements. And so what they have resorted to is, well, they're going to have to go back and renegotiate those double tax agreements. And so they've said that government intends to initiate these negotiations this year. All right, so they're going to have to go back to those particular double tax agreements and renegotiate to give dual taxing rights where there is a retirement interest, not an exclusive taxing right to the other country. Okay, and then something else with the retirement system is this two-pot retirement system, not to be confused with the president's statement in his State of the Nation address that he was going to promote the hemp industry and the dacha industry. It's got nothing to do with that. But this two-pot retirement system is looking at the retirement savings of people who have invested into the retirement system, and then allowing people to borrow against some of their retirement savings, but then counteracting that, in the other pot, that other pot is then absolutely watertight, and they would not be able to withdraw or borrow against that at all. So on the one hand, you've got part of your retirement savings, and that would typically be the 2/3 part that's going to give rise to that 2/3 annuity on retirement. That would be absolutely watertight, and you can't even dip into that when you change employment during your working life. And then possibly the other 1/3, this is all still open for discussion, but the other 1/3 would be available to be borrowed against, shall we put it that way? So on retirement, if you had a retirement interest of 15 million Rand, at the moment you can take up to 1/3 as a lump sum. The other 2/3 at least must be converted to an annuity. And so the idea is that you would maybe have been allowed to borrow against this one pot. And if you had outstanding liabilities, you would set that off up to the amount of that potential 1/3 lump sum. Okay, so it's keeping part of the retirement system more intact than it has been in the past, but then it's allowing people to borrow against the other pot, this kind of accessible pot. And so it's part of the issue that at the moment people, of course, have lost quite a lot of confidence in the retirement system. And often when people change employment, they just take their money out of the retirement system. And then they, on the other hand, they feel aggrieved that they are not able to access that money, even as a borrowings, if they are running into financial difficulty during their working life. So this is intended to sort of counter and address both of those issues. So they have put out a paper for discussion in December 2021, and that is open for, and at the moment they are considering the comments on that paper, and they say they will then have some public workshops to be followed by legislative amendments. So this is quite a big one. I mean, it's quite an important one in terms of retirement savings. And so if you have any interest in that, have a look at this discussion paper. As I said, it is quite far down the road in terms of getting comments, but it's not too late to get involved in the discussion process if you haven't been involved yet. And certainly to try and have a say before these legislative amendments are promulgated. Okay, and then back to a corporate tax issue, and this is the Section 24 allowance, and Section 24 being our debtors allowance. And Section 24 is a provision that has two parts to it. So we have Section 24(1) that talks about the actual inclusion in gross income, and it talks about where a taxpayer has entered into an agreement in respect of any property, the effect of which is that in the case of movable property, ownership will pass, or with immovable property, transfer will pass on the receipt by the taxpayer of the whole or a certain portion of the amount payable. All right, so you have a sale that takes place. There's a certain amount that's paid up front by the buyer, but ultimately the rest of it is payable over a certain period of time. Now, Section 24(1) tells us that you have to include the whole amount that accrues on day one, the whole amount under the contract, even though some of it's maybe only going to be received in year 2 or year 3, year 4, depending on how long the agreement goes on for. But Section 24(2) then gives some relief in terms of this allowance. Okay, so it's the debtor's allowance that applies if you've entered into this agreement where property is effectively transferred, etc., on payment of part or all of the purchase price. Now, the allowance is basically your gross profit percentage applied to the debtor's balance at the end of the year, but that only applies if the term of the agreement is at least 12 months, and at least 25% of the amount due is only payable in a subsequent year of assessment. All right, so it's a kind of a long-term period, 12 months, and this amount that is payable in the following year. Now, the issue here is lay-by agreements. And so the point has been made that lay-by agreements actually have become quite central in the whole retail industry in South Africa, that there's actually a huge number of lay-by arrangements where people, say, are buying school uniforms or household goods, and they buy it on a lay-by arrangement. So they pay a certain amount up front, the goods are kept for them. When they come up with a balance, they can collect the goods, and then they can take the goods because they've now paid for them. But the issue is, in the meantime, those goods have to be kept in reserve for the buyer. And the seller, the retailer, doesn't benefit from the Section 24 allowance there, because those lay-by arrangements are generally shorter than 12 months. And so government wants to remedy this by amending the debtor's allowance to limit the adverse effect on lay-by arrangements, which would indicate that they're either going to shorten this time period or carve out a special provision that would deal with lay-by arrangements, so that those retailers would be able to get the 24 allowance on the lay-by sales. And then this next one, dealing with the wear and tear allowance, Section 11E, but specifically on assets that are funded from government grants. Now, as you are aware, government grants are tax-free. Those are the grants that are listed in the 11th schedule or approved by the minister. And so if the grants themselves are tax-free, that money that comes in by way of a grant, which then funds expenditure, it makes sense that you would not be able to claim a tax deduction for that expenditure. And similarly, if the money is funding an allowance asset, you shouldn't be getting an allowance on those assets because the grant was fully tax-free. However, the point that's made in the budget is that it's come to government's attention that when a government grant in kind is acquired, the provisions for the wear and tear allowance could still apply. And that's because the wear and tear allowance refers to the value of an asset, not the cost of an asset. If you look at the 12C allowance or most of those other tax allowances, you base your allowance on the cost of the asset. And here you would say there's no cost because it was funded by a tax-free government grant. But the wear and tear allowance talks about the amount by which the value of an asset has deteriorated by reason of wear and tear. And on that basis, the argument is that you can still claim a wear and tear allowance even where the asset is funded by way of a tax-free grant. And so they're saying that creates an anomaly in the system. And so they want to change this to provide that actually you would not be able to get the wear and tear allowance in that case. So they want to align the tax treatment of an asset acquired as a government grant in kind with the tax treatment of assets acquired using a cash government grant. Okay, then on VAT, you're all aware of the changes to Section 72 that have come through a couple of years ago, and that has required people to go and apply for new rulings from SARS in terms of how to, variations on how the VAT legislation is actually going to apply. But it applies on a sort of a class system. So it's not an individual VAT vendor that would apply for a Section 72 decision. You would have to find other people in the same industry who are struggling with the same issues around the application of the VAT Act, and then you would sort of make a class application to SARS to get this ruling on how the VAT Act is going to apply to your particular industry. Now, what has happened is as some of these rulings have been processed is that SARS have identified that actually this is quite a broad-based application. And in that case, instead of having multitudes of different rulings, they have rather made amendments to the VAT Act. And so what they're saying is that this might happen more going forward. As they make reviews of some of the other Section 72 decisions, they might incorporate those into the VAT Act as well. And then amendments on electronic services, they're looking at updating the regulations. And then on the registration requirements, so electronic services, we're talking about non-resident foreign suppliers of electronic services to people in South Africa. Okay, so the idea there, you will remember a few years ago, those became subject to VAT. The supplier of the electronic service would have to register as a vendor if their taxable suppliers exceed R1 million, just like any other person. But what does not apply is with other vendors, the registration requirement is if it goes over R1 million, other than because of a once-off event. And so they want to introduce that once-off event exclusion for your foreign suppliers of electronic services as well. And then on the tax administration side, a few changes that they are proposing here. The one is to have joint audits with other international tax administrations. Now, apparently this is already happening, that you are already getting some joint audits happening. So this is just going to officially allow it to happen. That SARS can be doing combined audits on, say, multinational companies, where they do a joint audit with maybe the Australian tax office or the US tax office, whatever the case might be. The second one talks about an understatement penalty on employment tax incentives. I think that's fairly self-explanatory. So at the moment, understatement penalty would apply when you've got an understatement relating to income tax, VAT, et cetera, but it doesn't specifically apply to employment tax incentives. But government has indicated that they do think there's been widespread abuse of the ETI. And so if people are overclaiming the ETI, they want to have that subject to the understatement penalty, which could then be a penalty as high as 200% on the shortfall, the amount of tax underpaid as a result of the overclaiming of the ETI. As far as your registered tax practitioners are concerned, we've got our recognized controlling bodies, and there's one recognized controlling body that has indicated that they don't need to be such, and so they are going to be removed from the list. And then lastly, on tax administration with business rescue. All right, so the issue is around tax compliance status for taxpayers that are under business rescue. Now, to have tax compliance status, you need to be registered for everything that you are legally required to be registered for. All your tax returns must be up to date, and you must have no outstanding tax debt other than where you have entered into payment arrangements with SARS, or you've got a suspension of payment, or you've actually entered into a compromise agreement with SARS. But the problem is that taxpayers under business rescue, especially in the early stages of business rescue, sometimes have not been able to make these payment arrangements, and that compromises their tax compliance status. So the statement is that SARS cannot reflect a taxpayer as being compliant if it has outstanding tax debts, unless, of course, you've entered into these payment arrangements, etc. And this may not be possible in the earliest stages of business rescue, which may negatively affect the prospects of the rescue being successful. And so it's proposed that SARS should be empowered to assist in these cases under certain conditions. So they're going to investigate that. It's going to be interesting to see what they're looking at coming up with there. Let me just have a quick look at the chat. So developers in foreign countries providing services to local companies. So you look at all falls, you'd have to look at the regulations there, and it does get quite complex because it depends. It must be an electronic service provided by a non-resident to a South African resident. And if that is the case and the taxable suppliers exceed R1 million, then yes, they would have to register for VAT. But you need to actually look at the regulations. Are there any PAYE implications for foreign service providers? Well, it's difficult to say. I don't have enough information to go on here to say. If there is remuneration, you have to look at the normal provisions of the 4th schedule, right? If there are employees who are earning remuneration as defined, which is subject to employees tax, and the employer has the obligation to withhold the PAYE. Okay, in terms of future developments, so government has indicated that they want to review the approach to adjusting the thresholds for inflation. So that's at 4.5% adjustments that we saw this year. They want to review that. So not quite sure how they want to review that going forward, but nonetheless, that's what they've set up. And they also want to review depreciation and investment allowances. Okay, so this is the write-off of your assets, all your various Section 12C, Section 11E, and how those allowances are actually calculated. So they will release a discussion document on that. Okay, just wanted to show you the latest interest rates. And so, of course, SARS has table 1, 2, and 3, which you can see on their website. And remember that these interest rates are all linked to the repo rate as set by the Reserve Bank. And so as we've seen 2 recent increases in the repo rate, we see that these interest rates also increase. And so from the 1st of March, interest payable to SARS has gone up to 7.25, interest payable by SARS 3.25. The official rate of interest for low interest loans, that went up on the 1st of February to 5%. So just be careful of that, especially if you're doing your deemed dividend calculations, etc., for your low interest loans or deemed donation calculations under Section 7C. Make sure you're using the right interest rates as per the SARS tables. As I say, you can get those on the SARS website. Just another point, another thing that they mentioned in the 2021 budget, and some of you might be just about to ask me about this, was this proposed amendment to curb loan transfers between trusts. So looking at Section 7C, this anti-avoidance provision, which specifically applies where you've got a loan advanced from an individual to a trust, or from a company at the instance of an individual to a trust, or to a company owned by a trust, etc. But essentially, it doesn't apply to loans that go from trust to trust. But what they wanted to put in last year, and what they were proposing, is that they wanted to make an amendment to Section 7C to counter certain schemes where basically you had transfers from trust to trust. However, that went through the whole discussion process, and the final response document that came back from SARS and National Treasury, after having considered all the comments on the draft legislation, was this. They said a risk was identified that through the use of low interest loans between trusts, taxpayers could achieve tax-free disinvestments from companies facilitated through loan arrangements. But they do acknowledge that Section 7C was specifically introduced to curb the use of low interest-bearing loans, and as such, it was not appropriate to proceed with the amendment that they had put on the table. And so those changes that were in the draft bill have been withdrawn, and at some stage they'll look at a more specific anti-avoidance measure. Whether we will see that coming through this year, I don't know, because we haven't heard any further mention on that in the budget speech. Just lastly, and then I'll come back to the questions. I'm not going to go into this in detail, but just to mention that there was some revision around exchange control, specifically relating to both individuals and companies. So I've just listed those very quickly on there. I'm certainly not an exchange control expert, so I don't propose to speak to that, but I just wanted to list it just to make mention of the fact that there have been these relaxations. And then we can come to our questions. All right. Okay, somebody had to leave. That's fine. And here we have from Anonymous. I have a client whose tax compliance is affected by having taken advantage of the COVID relief on the monthly PAYE. The last payment only due this month, but since December, this compliance certificate. Okay, I can't comment there without knowing specifically, because first of all, you'd have to say, were you eligible for the COVID relief? And remember, you know, that can change on a day-by-day basis as to whether you were compliant and eligible for the COVID relief. That's very difficult to speak to in terms of not having the details on this. But if the compliance certificate has been compromised, your first port of call is to say, were you eligible for the relief? If so, are you still within the relief that was provided, in which case you don't actually have outstanding tax debt, and then you should approach it on that basis. Okay, so you would need to deal with that with SARS. Okay, and I think that I don't see any other questions right now. So let me hand back to Stan in a minute. Oh, here we go. Capital gain in Trust A was paid to Trust B and then paid to beneficiaries. Does it still retain its capital gain status? Well, this talks about capital gain flow overs from trust to trust. At one stage, SARS was vehemently against that, but I think they have recognized that it can happen, that it can go from trust to trust and then to a beneficiary. I certainly, yeah, I would have to just check on that, but as far as I know, it can be done. But what I would suggest you do is have a look at the SARS Comprehensive Guide to CGT, and specifically the chapter that deals with trusts, and just have a look at what they say there, because they have changed their view on that over the years. Okay, any other questions? Great, pleasure.
Thank you,
I want to make a... Oh, sorry,
no,
go ahead, Stan.
Carry on.
I just want to say, if anyone wants to ask a question, I can give them permission to talk. If they don't want to type out a question, just let me know, raise a hand or in the chat, and I can do that for you.
Okay. In the interim, thank you, Jackie, for interesting, really in-depth discussion. Some of the stuff quite mind-blowing. And thank you again. And your certificates for everyone will be on their way to you. If you haven't paid, please do so. If you need anything like the notes or the recording, it will be circulated within the next day or two. So once again, thank you. Thank you for joining us. And we're looking forward to the rest of the year. We'll be bringing more from Jackie and more from other presenters as well. So thank you again.
Just quickly before you end, a question around the provision for doubtful debt, section 11J. No, it's not still 25%. You just need to go back and have a look. That provision was amended quite extensively a couple of years ago. And then, okay, I think you asked that on two places. Okay, so just to mention about that. Yeah, otherwise that's it. Thanks very much. Yeah. Thanks, everybody. All the best.
Thank you again, Jackie.
Thanks. Bye.
Thank you again. Good night, everybody.
Cheers. Take care.
Bye.